Lately, the market has shown a very unusual sign. With the escalation of war, crude oil has surged, but gold hasn't soared as many people expected. Instead, it has fluctuated at high levels and even pulled back at times. This raises a very crucial question. Why is it that when war breaks out, crude oil goes crazy first, but gold doesn't follow the usual safe haven script? And which side will Bitcoin take next? First, let's look at crude oil. The direct reason for the surge in crude oil prices isn't that the market has suddenly become more pessimistic, but rather that this war has struck the most sensitive nerve in global energy transportation. The Strait of Hormuz has always been one of the most critical energy choke points in the world. Both Reuters infographics and reports mention that this area typically handles about 1/5 of the world's oil shipments. If the safety of passage here is compromised, the market's immediate reaction is not to price in sentiment, but rather the risk of supply disruption. So at this stage, instead of focusing on all sorts of rumors that are hard to verify, it's better to keep an eye on the two most reliable indicators. First, the war risk and insurance premiums related to oil tanker transportation. Second, Brent crude oil futures, because both of these indicators reflect the outcome of capital voting with real money. In the past few days, the market has already priced this kind of risk directly into prices. According to a Reuters report on March 9th, oil prices surged by about 20% during early trading, reaching their highest level since 2022. But then sharply retreated as the market began to speculate on the release of strategic reserves, the duration of the conflict, and expectations for shipping recovery. In other words, what's being traded in oil prices isn't just slogans, but the actual physical constraints on oil transportation. Now let's look at gold. Many people might find it strange, according to common sense. When war escalates, oil prices soar, and global risks rise. Aren't these all classic indicators for gold to surge? Even before the fighting started, gold had already been pushed above $5,100, and at the end of January, it even hit a record high of $5,500 per ounce. By that logic, shouldn't gold rise even more sharply once the fighting actually breaks out? But in reality, gold didn't skyrocket in a straight line. Instead, it fluctuated at high levels and even started to decline. Why is that? Because when the market is truly hit by a shock, the first reaction is often not to buy the safest asset, but to make sure you have enough cash on hand. Reuters analysis on March 3rd put it very bluntly. After the sudden escalation in the Middle East, the market experienced a very typical dash for cash. That means stocks, bonds, and even traditional safe haven assets like gold were all sold off together at first. Because what institutions need to address first are liquidity, margin requirements, and position risk. Cash actually becomes the top priority. This is where gold is most easily misunderstood by ordinary investors. Gold is indeed a safe haven asset, but at the same time, it is also a highly liquid, large position asset. Once the market experiences sharp fluctuations and institutions are short on dollars, margin, or liquidity, gold may actually become one of the first and easiest assets to be sold off for cash. So the saying that war is bullish for gold is not wrong, but it's only half right. If the market first trades on the safe haven narrative, gold will rise. But if the market first trades on liquidity stress, margin pressure, or cash demand, gold may fall first. Moreover, this time gold is under pressure not only because of liquidity, but also for a second reason. High oil prices will push up inflation expectations, and those inflation expectations in turn support the dollar and interest rates. Gold itself does not pay interest, so as long as the market starts to worry that if oil prices keep rising like this, it will be even harder for the Federal Reserve to cut rates, gold will be suppressed in the short term. A Reuters report on March 11th mentioned that a core reason for the pullback in gold prices that day was the strengthening of the US dollar, persistent inflation concerns, and rising expectations in the market that high interest rates will last longer. Reuters also mentioned on March 5th that high oil prices are fueling inflation concerns and pushing up US Treasury yields, which is not favorable for gold in the short term. So, as you can see, it's not that the safe haven logic for gold has failed this time, but rather that the market has been trading two completely different sets of logic at different stages. In the first stage, the market was trading on geopolitical risks, which drove gold prices higher. In the second stage, the market was trading on cash demand, margin pressures, a strong US dollar, and high interest rates, which caused gold to pull back. If the liquidity shock eases later on, and the risks of war and inflation continue to intensify, then gold may once again return to its main upward trend as the ultimate safe haven asset. This is actually very similar to what happened in 2008. At the very moment when the crisis hits, gold doesn't immediately soar. Instead, it plunges first because it's sold off to raise cash. Only after the most urgent wave of the liquidity shock passes does its safe haven attribute get repriced. So what about Bitcoin? Now we've come to the most interesting part. The most awkward thing about Bitcoin right now is that its identity has never truly stabilized. Since the start of this market cycle in 2023, the narrative around Bitcoin has consistently been that it's digital gold. But whenever a real macro shock occurs, especially during times of war, people in the crypto community are often the first to have their wallets hit, and the market tends to treat Bitcoin as a highly volatile risk asset. According to the latest market data, Bitcoin is hovering around $70,000, and intraday volatility remains significant. So, where Bitcoin goes from here ultimately depends on what the market chooses to trade next. If the market continues to trade on a strong US dollar, tight liquidity, and declining risk appetite, then in the short term, Bitcoin will most likely still behave like a high beta risk asset, similar to the Nasdaq. However, if the market starts to further doubt the fiat currency system, worries about stagflation caused by energy shocks, and concerns that traditional assets cannot hedge both stagflation and geopolitical risks at the same time, then Bitcoin may have a chance to once again be regarded by some capital as a non-sovereign, anti-dilution, globally liquid alternative safe haven asset. In other words, Bitcoin is not inherently a safe haven asset. It must first endure being sold off as a risk asset before it can even qualify to compete for the position of digital gold. So, in this round of market activity, the most noteworthy aspect is not just the war itself, but rather what exactly these three types of assets are trading on. Crude oil is trading on expectations of supply disruptions, gold is trading on liquidity and interest rate expectations, while Bitcoin is trading on whether it still belongs to risk assets or is truly starting to be repriced as digital gold. If we can clearly understand these three threads, we won't simply be asking why gold hasn't surged in price during the war. The real question should be whether what the market lacks most right now is a sense of security or cash. This is WinFilter, interpreting macro phenomena with hardcore data. See you next time.